Hi again on CSCAP TV. This video will be devoted to the smart money mechanics. On the example of order block, I will show you the internal market process that will clarify why smart zones work like they work. Before we start, in the description you will find the link to subscribe to the Signals channel and use this source as a screener to find best setups. I really enjoy grabbing several setups for my trading session just to avoid wasting time sitting in front of the monitor. Here is the plan for today's video. What is smart money concept first of all? We will discuss as well what is order block as we use it as example. Then I will show you the mechanics and strategy itself, and finally real trades example. The smart money concept is a trading principle focused on understanding and leveraging the market movements initiated by institutional investors, not retail, such as banks and hedge funds. This concept in fact includes many strategies, all the aspects that imply trading along with huge capitals. But today we are talking about smart money in the context of smart zones trading, and I took order block as example. Order blocks refer to specific price areas where large market participants, such as institutional traders as I said, have previously placed significant buy or sell orders. As you know, it's difficult for institutional participants to load their multi-million dollars position quickly. Therefore, huge guy grab liquidity for a long time. Unless ourselves, who can really load position by one click, he is loading inside a huge and really long consolidation. However, there is a popular scheme to do it quickly by just creating extremely high local demand from retailers to satisfy huge players' needs in very short period of time. Sometimes huge players use a manipulation based on hedging for this purpose. Let's dismantle this process. A huge guy see the consolidation, the intention of retail to make a breakout, so he used this situation to his advantage. Let's imagine his capital is about $300 million. It's a hedging fund or something like this, or bank. So this really fat guy placing limit orders for sale on the border of this breakout, where retailers really want to make this impulse, to catch this impulse. First of all, he opens a trade for, let's imagine, $25 million. He just opened this position simultaneously, making a small limit orders, pushing the price towards this potential breakout. He just shows the retail that, hey guys, we're gonna break this level. And this retail really rise in confidence. Huge player spends $25 million to organize and provoke this movement. What finally happens? This breakout really occurs with a very high volumes because many small participants, many retailers take part in this breakout because it's one of the most popular scalping strategy. And as you remember, the huge player places really huge limit orders here for sale against the movement. For example, for $150 million. You would say it's dangerous because he's placing the limit orders against the movement of retail. Yes, but the retailers start to fix their positions. They start selling and reversing the price back. With this position opened and executed, the price starting to get lower and lower because huge positions were loaded here and many traders sold their position here just to fix their profits. And this synergy effect just turned price to rebound and getting back lower and lower. The process just initiated. But we still remember that this position for huge player is still opened because it's almost impossible to close it in break even, because $25 million position is really hard to close quickly, especially on the background when the price is getting lower and lower so fast. So this position is giving really huge minus for this huge guy. He needs to close this position, to close this hedging position in zero. However, this core position for 150 million is getting more and more profit. The huge player is starting fixing this position with limit orders, what is leading to the price increase again. When we are getting to the break-even point, this fat guy closes the last position, this 25 million position, in zero or maybe in small minus. And for the reason that $25 million were executed in this point, there is a pullback again, because there was a huge sale. The huge player just made a really huge profit on this scheme. So we have the opportunity to do the same, of course in smaller scales. But anyway, we just find this order block in a logic place and waiting for the price to get back to this zone when a huge player picks their hedging position, and there will be the rebound. There is an excellent example on XRP USDT. There is an order block, as you see. There was fake breakout, then the price returned back, broke the structure. And on this period, you see that the huge guy just started fixing the position, and then the price getting back to this order block and pulled back from this. This is our entry point with a stop loss behind the zone. Every time we trade an order block or any other type of zones, we should be sure that this zone is placed on a very logic place. As you see, there was the grab of liquidity here. We have no liquidity higher than this level. That's why this zone is very relevant. Here we place our limit order for sale with your working volume. The stop loss 0.2% behind or above the zone, and the take profit here with the ratio no less than 2 to 1. This ratio will ensure you to stay profitable, and it will give you really good risk-reward ratio. Now let's switch to the example of the trade. I often show this trade as an example of order block workout and Pendle USDT. Here you see the order block formed on 15 minutes time frame, and there was a really instant reaction from this order block where the price were moving between zones of liquidity, between smart zones, as you see. That time there was really good opportunity to get profit with the movements between these zones. But however, as you see, the reaction was really instant. There wasn't full potential from this trade because the BTC were getting down. Look at this again, the really instant reaction from this zone. There was just a single touch to this zone and the instant reaction, very fast and profitable. And this trade wasn't the best one because there wasn't a full potential. There are some other kinds of zones. As you see, we call them thresholds. They look like this, and they are formed with a very short stop of the price on the way of really good and confident impulse. If you really want to figure out more about touch zones as well, please write it in the comments and we will make a new video about this. I really hope this strategy is clear and it will help you to earn more. The strategy is really relevant at any market. Thank you for your attention. See you soon.